The first half of 2020 has been one of the most volatile in stock market history, alongside unprecedented monetary and fiscal support, of course, to help the economies. Much of what was lost in March in terms of stock market value has been bought back, with a disproportionate amount of money going into tech and pharmaceuticals. What about Q3 and the rest of 2020? Robert Alster joins us now from Close Brothers Asset Management, where he's head of investment services. Robert, it's good to talk to you, and what a great time to be talking. I mean, I've been reporting the financial markets now for a quarter of a century, and I'm running out of superlatives, if I'm totally honest with you, as to how to describe this. Before we get to Q3 and beyond, how has the last 4 months been for you, as someone, too, that's been in the markets a long while?
No, you're absolutely right, Jeremy. It has been tumultuous, is the word to express it. It's the speed of the drawdown as the pandemic spread, and then the markets bottoming and anticipating recovery with a bounce back gave investors very, very little time to reorientate themselves and see how to position themselves going forward. And if you compare it to the last financial crisis, back in 08, 09, the speed of this one, both down and up, is unique and does offer a lot of opportunities still, because obviously, there may be a second wave and markets are already discounting a lot of the recovery over the next couple of years.
One of the things I've certainly learned over the last 4 or 5 months or so is that there seems to be a bottomless pit of opportunity so far as monetary and fiscal stimulus is concerned. Certainly central banks and governments have demonstrated their will to keep things going as long as possible. And I'm mindful of what Mario Draghi said about the Eurozone a couple of years ago. They'll do what it takes to support the euro then. And I guess it's the same now for central banks and governments now. No one wants to be seen to be at the helm, delivering a massive economic and stock market shock. Can we seriously expect, do you think, this sort of unprecedented stimulus to continue?
I'm really glad that I'm not a central banker at the moment. In some ways, it's easier being involved in investment and markets because their challenge is unique and they have to kickstart the economy. They have to get demand back. There is no other way forward. They have to spend. Debt will go to the highest levels that we've seen, since the Second World War. So you're going to expect and get more fiscal and monetary and unique demand-led policies, whether it's a cut in value-added tax coming forward or whatever, because we have to get demand back into the economy to overcome the huge air pocket that we've all experienced locked at home in the last 6 months.
How are you approaching your job, though, bearing in mind the one big thing we know that we know nothing about is the second wave potentially of COVID, how deep and how wide that could possibly be? It's such a very difficult position to be in. I mean, you say you're pleased you're an asset manager as opposed to a central banker. This is so difficult to know where to put money. It is unprecedented times, as we've said. How are you going about your job?
Well, there are structural winners that are coming out of this, despite the tragic consequences in terms of life and illness, etc., to do with the pandemic. And the structural winners are, people like me and yourself working from home. Clearly, our demands for online, the internet, video calling, food deliveries, all sorts of packages arriving in your house means that the technology companies are emerging from this as winners. And, I remember one chief executive saying to us that 5 years has been compressed into 6 months. That's the acceleration that they've seen. And I think that carries on. It may not carry on at the same pace, but I think those trends structurally do carry on. And another winner, I think, will be healthcare. I mean, obviously, there's a race on for the vaccine at the moment, crucially important. But I also think, the way that we view and the way politicians perceive healthcare companies means that they will change and that there'll be winners out of this as well, whether it's through better pricing or just more support in terms of research and development. And the stock market understands that, which is why those two sectors and the shares in those companies have done well.
It's interesting you mentioned both those. I mean, AstraZeneca, I think now is the largest company here in the UK, I believe. Certainly it hit that a short while ago. It's just off the highs at the moment, but I think it's still up there. In the US, of course, the NASDAQ record high has been led higher by the likes of Apple and internet companies like Amazon, of course. You mentioned us all online and working from home, these companies that take advantage of that. Before we take a look into some more detail about precisely where the money's going that you're putting into the market. Just want to ask about the big picture so far as you're concerned. Are you holding back? Are you storing cash on behalf of clients, or are you fully invested?
No, we are holding back cash. You're right. Our investment managers do have higher cash levels than normal, and they're looking, evaluating, doing the research to figure out where to go and invest that cash, where to pick up structural, longer-term growth winners which have been mispriced as a result of what's happened with COVID. So the cash levels are higher, and the shares that they hold, they're in about a neutral position, and we can continually debate what are the chances of a second wave, what will be the magnitude of the economic hit of a second wave. But I also think that a second wave will be more taken into account by the market in a way. It's seen what's happened in the first wave and is now more accustomed to it, so it will be more nuanced. So yes, we are waiting and looking to invest, reduce those cash levels and buy the structural winners.
We mentioned tech, online, working from home. You mentioned some of the food delivery companies, those essential markets that we all so desperately need, the food supplies and so forth. What about other sectors? Do you see any other sectors where there's a good place to hide, or are you wary of pretty much all else that's sort of being offered at the moment?
Yeah, I mean, a couple of points on that. You talk about the online and the obvious winners like the Amazons and the use of the internet, but behind those companies stand long supply chains, industrial companies, for example, that have to put in the automation and the digitalization of their factories, the consultancy companies that actually take on board projects and help companies become more automated. So there's a lot that's happening behind the scenes that the consumer, if you like, doesn't quite see, and they'll all be winners. And that structural change carries on. There's a company that's had its employees locked out, couldn't do the automation and the maintenance, and is now thinking, well, how do we do this on a permanent basis, not just during a pandemic? So there are winners like that. But the other area, of course, to look at are those that have been hit the most. I mean, the hospitality companies, restaurants, pubs, airlines, train stations, those share prices are down and they've lost 50% of their value since the beginning of the year. And some of those are going to rebound back and actually become stronger. The weaker in these moments of crisis tend to go to the wall, and there's consolidation, and you actually get companies coming through with stronger profitability and growth prospects. So you need to look at that as well.
And of course, that's the Warren Buffett theme, isn't it? That when people are fearful, you step in with the greedy buying up of these stocks. But that being said, we don't know how far down we're going to go. As I said, one of the big unknowns is just what's going to happen with COVID. And you mentioned the hospitality, the airline sector is a really good example. I think this week we've heard something like 17% of Airbus cutting back. We've got jobs going at Ryanair, EasyJet. They don't know what the future is going to be like. Are you investing in airlines at the moment at these low levels, for example, and other companies that have hit lows, or are you waiting for another opportunity to get into at a lower level?
I think the airlines, you've got to look at which business models are going to work. And, we've done our work in that area, and we still think that the low-cost model and low-cost airlines have both got the strength, the financial strength to weather this if there's a second wave or even a third wave, as we've discussed. And also, who would have thought, 2 or 3 months ago, that we'd all be thinking about flying today to parts of continental Europe? So the pickup is coming through faster than we all thought. So that is an area of the market where we have some investments, yes. But you've got to be careful here because there could be a second wave. So you're playing it sort of month by month, and that's the issue with this market. That's why the volatility is still there, because there is a degree of uncertainty, even if the longer term is more assured.
What about geographical allocation of investments at the moment? I mean, we've spoken about what's happening here in the UK with some UK companies. We've spoken about the big US tech companies. Are you impressed with some areas of the world over others? I mean, we haven't spoken yet about mining. I'm mindful of the fact we've seen copper at a 5.5-month high. You've got the Australian dollar rising on the back of expectations that miners are going to be doing well in the next few months. China's demand seems to be picking up. And the Australian benchmark, of course, is doing very well. How about other sectors like that? And when looking at the global level.
Yeah, looking at it geographically, I mean, we had a meeting exactly about this, and the high conviction consensus, the high conviction views from where we are is towards the US. The US tends to emerge from these crises quicker. They usually take quite dramatic action, whether it's trimming back their workforces, repositioning themselves, and we think it's the same, which may surprise you because, of course, we're seeing some states go back locking down again. But nevertheless, the US is the size of Europe and bigger, and it's a very diverse economy. And I think the bet that they've taken to reopen early the economy, despite the fact that COVID is still around, we think is going to pay off. So yes, we do tend to have a preponderance of our investments in the US at the moment. That would be fair. China, which you also mentioned too, is, if you like, the lead. They went into this first, perhaps for all the wrong reasons, and they're coming out. They've done very well in terms of containing it, and they're coming out. So people are often looking at the Chinese to see what are the trends that might happen here. And I remember a statistic when Disneyland opened in Shanghai, everything was sold out in like the first half an hour. So that gives you some idea of the sort of pent-up demand that I expect we're going to see in the UK, both this weekend and over the next few weeks as well.
Yeah, one of the things I've been writing about has been this US market, as you mentioned, is the flexibility, the relative lack of regulation, and the ability for companies to be able to bounce back quickly. And of course, we got the US elections a little bit later on this year, which have also, in history, have been an opportunity where we've seen markets rise. One wonders just what Donald Trump has yet now left to go in the barrels that he's got in order to make sure that the markets continue to rise. I mean, he's only got 3 or 4 months to go before the real test comes between him and Biden. How are you feeling about that aspect of things? Are you bullish on America because of that as well?
Well, it'll be a brave person to try and second guess on what President Trump is going to do between now and November. But we are feeling reasonably positive about the US. President Trump's talked in the past about a big infrastructure program, as has virtually the government of every Western economy, as a really good way of kickstarting demand coming through, getting employment going. And I think the US will be the same. But you've got to be careful in the US because clearly, Biden as a contender is gaining ground in all the polls and has done very well in the recent polls. And of course, that will matter a lot for the banking sector in the US in view of his stated aims to perhaps break up or put more regulation in place on big banks. And also the healthcare sector will be treated by investors very differently if there's a Democratic win. It will be far more about bringing back Obamacare, whereas President Trump was far more about keeping costs down. So it'll be very interesting for both the tech sectors and healthcare in the US. That will really matter depending on which party wins and how investors are likely to place their bets.
Before we get there, of course, we got the second quarter earnings season coming up for the US, starting off with the US banks actually in about 10 or 12 days' time. How fearful are you for this round of earnings? I mean, analysts have been finding it very difficult to call. We know that economists have found it very difficult to call economic data. How difficult is this earnings season going to be, do you think? And I mean, is this going to be a reason for people to sell out of the stock market if it is particularly bad?
Yeah, that's a very good point. The problem for the market has been that companies have withdrawn guidance because of the huge uncertainty that they face in boardrooms, chief executives, etc. So they've withdrawn guidance, and of course that makes it even harder for analysts to come to a view about their forecasts. So I'm afraid I think you're right, that the volatility will be quite large in the second quarter, depending on whether a company beats the market expectations or not. But to some extent, the second quarter is rearview mirror. We've had such a rebound in markets that they're looking ahead to 2021, 2022. So they've built in that recovery. And why have they done that? because, as you mentioned earlier, because it's record fiscal policy, record low monetary rates, and it is that has propped up the economy. It's bridged the gap through this negativity. So as long as there's no big second wave, I think everybody on these calls will be looking to, well, how's the recovery going? What are you expecting for the next 6 months? Rather than looking back and saying, well, how bad really was it before? I think it's going to be a very different angle to how these numbers are taken.
One final thing I just want to really cover with you, and that is the amount of debt. It, in some respects, goes back to what we were talking about at the beginning, the amount of debt that's been racked up. We already know that the consumer's heavily indebted, governments are heavily indebted. We know now that there's lots and lots of debt now on the balance sheets of central banks around the world, trillions and trillions of dollars overall. The Federal Reserve recently has come up with a nice neat little trick, and they found another magic money tree in the form of buying corporate debt now. Yes. Is this going to be a new thing, do you think? I mean, it just compounds this debt thing that we've got going on. How worried are you as a money manager in having to keep people's investments up to date when you know that there's this massive wall of debt, and so long as they keep printing money, ultimately, presumably, inflation has to rise?
Yes, well, in some ways, there's no choice. I mean, what happens in a crisis is that your time horizon shrinks into the immediate future. So rather than looking 1, 2, 3 years out, what happens is you're looking 1, 3, and 6 months. And on that time horizon, there is no alternative, if you like, to building the debt, wherever it is, whether it's in corporates, whether it's on the government's balance sheets, or households. So I think that's a given. So the question becomes is, as we get the economy back, as we get demand back, how stifling will that debt be, and how would it be managed? And there's only 2 or 3 ways that debt can be managed. I mean, you can either agree to write it off, which doesn't seem very likely. You can do what we've done in the past, which you've alluded to. Inflation comes back, and over time you, if you like, inflate away your debt. But I don't think that's likely, because the numbers are just too large for that to happen. Or you push it out. You issue perpetual bonds. You push it out 1, 2, 3 generations hence. And I'm afraid I think that's what's going to be happen, or an amalgam of all 3. But I find it very hard to imagine inflation coming back. You've got deflationary effects of people being furloughed, job cuts, technology pushing down pricing as well. I think inflation is going to be very low for quite some time. And against that background, we as investors, it's shares where we go to and have a look at, because longer term, they are basically the growth engine. And also they'll be giving you an income, a yield more than in debt, which will be very lowly priced simply because there's so much of it.
Keen advice. Look, Robert, thanks indeed for joining us for this wrap up of where we're going to third quarter this year. It's been a pleasure, and thank you so much indeed for your time and your busy day. That's Robert Alster. He's joining us there from Close Brothers Asset Management, where he's head of investment services.